Well, welcome to the program again, Michael. It's great to have you on what is our last rendezvous in 2020.
Yeah, thanks, Simon. Great to be here again, and hard to believe such a unusual year and challenging year has managed to still go as quickly as it has, because at times it's felt painstakingly slow.
I agree. I've definitely felt like this has been a really, really long year, but at the same time, we're at the end now and it just seems crazy. Someone did say to me the other day, though, just because it goes January 1, 2021 doesn't mean that everything that we're feeling at the moment changes. And I think there's a few out there that are perhaps thinking that might be the case.
I agree with that. Unfortunately, it's not a nursery rhyme. And yeah, I suspect there might be some disappointment, particularly in the first quarter or first half next year. Yeah.
Well, obviously, the big thing that's happened since we last caught up was the US election, and we have a new president.
Well, it depends who you believe. According to some Republicans, maybe not. But yeah, I think the widespread view is that Biden's won and won quite well. I think he's got a clear mandate from the numbers. And I think going into it, the market sort of most probably felt that equities would do better if Trump won. He was most probably seen as more pro-business. But interestingly, we've seen a very strong equity rally post the election, maybe 7-8%. We've seen the Dow take out its pre-COVID highs. The NASDAQ and S&P 500 had already done that before the election. So, yeah, the market certainly, I think they're looking at it saying, well, a few things. One, whilst Biden mightn't be seen as pro-business, he's seen as most probably being running a bigger spending government. The fact he's not controlling both houses, or it doesn't look like it, suggests that he may not be able to put some of the tax increases through that the market was sort of considering a risk. So it's a bit like a Goldilocks type approach. My understanding is US equities historically perform better when you've got a divided house, which is what we look like having there. I guess the other big news is that the very promising updates on the vaccines, and there's not just one, there's a few that are both showing 90+% in trials success rates. So clearly that combined with the uncertainty and event risk of the election being over has seen a much more buoyant market.
And the central banks have had a little bit to say over the month as well. What have you been hearing there?
Well, the RBA had their quarterly statement of monetary policy. They cut rates, the official cash rate, most in all likelihood for the final time, from 25 to 10 basis points. That was pretty well expected. What they did do is they changed tack a bit on the quantitative easing, and then previously they were very much targeting the 3-year maturity part of the curve, and they were trying to get the 3-year bond rate, government bond rate, pretty well flat to the cash rate. And they've been successful at that, and trying to give the market confidence that there won't be any movement in interest rates, most likely for the next 3 years. So being able to maintain a flat yield curve from the cash rate to the 3-year maturity. I think one of their concerns was the longer part of the curve was actually higher than a lot of our major trading partners and other major economies. So if you look at the 10-year Australian bond yield, we were trading at more of a premium than I think the RBA wanted. And that had two issues for them. One, businesses, when they invest, historically look at the longer end of the curve. They're not really looking at 3 years, they're looking at 5, 7 or 10 years. So I think the RBA felt if they could flatten that yield curve and get those longer dated bond yields lower, that would help investment. And that's a key part of, obviously, GDP. I think the second thing in their mind was that they wanted to take a bit of upward pressure off the Aussie dollar. So whilst they've acknowledged, if you look at trade, iron ore and some of the key commodities, and where the interest rate differentials were at the long end of the curve, their view was the Aussie dollar was fairly valued. But I think what their concern is that they don't want the Aussie dollar gaining strength, too much strength or too quickly. So I think they felt was if they could bring the longer end of the curve more into line with countries like, the US, New Zealand and others, they felt that they may take some of the pressure off the Aussie dollar strengthening further. So, and initially they were successful. We saw that differential with New Zealand. I think we're now only about 5 basis points higher. Before we were about 30. We are a lot closer now to US bond yields, and in fact, some days we've virtually been trading flat. Unfortunately, what's happened in the last week or two is with the vaccine, the optimism in the market, and that I guess viewpoint that economies may pick up a lot quicker than previously forecast, we've seen the long end of the curve actually sell off again. So in the last month, the 10-year bond yields are up about 20 basis points, which is quite counter to what the central banks, and particularly RBA, have been aiming for. But when you think about it, the price earnings ratio in the Australia broader equity indexes are above 40. Now, long-term average is 16 to 18. So what that says is the markets are looking through the downturn in results this year, and they're pricing in a very strong recovery. Now, the vaccine news has clearly pushed that along further. But if you think, if that's right, and those price earnings ratios are justified, and we are going to get a quicker recovery and the vaccines are effective and we can roll them out quicker than maybe we thought, it's very hard to keep a 10-year bond yield lower. You can do it in the 3-year end of the curve because if you don't move the cash rate for the next few years and you buy bonds, you can more easily do that. But the longer end of the curve is more challenging. And I've said on this sort of these podcasts before that people need to really pay attention to that yield curve, particularly the out beyond 3 years. And even the 3-year, when that starts to go above cash, it may indicate an imminent tightening in monetary policy. So in 2 or 2.5 years' time, you might start to see that. So I think all in all, there has been a bit of a disconnect between the equity markets and the bonds. And I think the bonds have now caught up a bit. But ironically, if the bond yields keep if they keep drifting higher, that's actually not great for equities. So it's going to be interesting to see that relativity going over the Christmas New Year period.
And what about on the FX side? Has it had an impact on FX?
Well, the Aussie dollar, I think I've mentioned before, looks as solid as a rock, around 70 cents. And I'm a great advocate for looking at historical price actions and price points. We did briefly dip under it. I think we got to about 69, 93 or 95 around that US election, but we've bounced back really quickly. So my view's always been, if you're an exporter, you really want to be buying Aussie dollars just above 70 cents. And if you're an importer, you've certainly got resistance from 73.40 to 73.90. I think 73.90 is the high for this year. But looking a bit longer term, if commodities hold up and there's not a deterioration in the Australia-China trade sort of rhetoric and issues, it's certainly not that difficult to see the Aussie dollar up to 75 cents and beyond. And there are some forecasters saying we could even touch as high as 80 cents next year. And I think that's been part of the RBA thinking to try and make that a bit more challenging. So, yeah, I think the Aussie dollar continues to hold up quite nicely. It's got some things in its favour. The risk for it, as we mentioned, is obviously the Australia-China trade. If China start to put further tariffs on exports, that's clearly a negative for the Aussie dollar. I think also if COVID escalations continue and or the vaccine rollout is not as quick as current or as effective as currently being priced in the market, that potentially would slow global growth next year, and that would be a negative for the Aussie, and you might get some related downward pressure on certain commodity prices. So they're most probably the risk for it, but at the moment it seems to have more headwinds than tailwinds.
And for treasurers out there, as we go into sort of the December, Christmas, holiday period, what should we be keeping our eyes on?
Well, I think as we said last year, the market liquidity over Christmas New Year historically drops off. So you do often get opportunities. We got a great opportunity for importers in early January this year. The Aussie hit its highs around 70-30, 70-40. Admittedly, COVID, took off in February, March, and then the Aussie came off. But it's not unusual to see, I think if you go back to, 2018, it might have been, where the Aussie dollar traded at 67, sort of 80. Second trading day in January, it dropped about 2.5 cents on no volume, then went straight back up. So I always like to have some orders out there in these thinner periods, both sides of the market, because it's amazing. You can get set at levels that you may not see when the full liquidity returns. So I think if you're an exporter, any dips towards 70 cents, I think you'd be looking to at least be buying some Aussie. Importers, I think up around the high 73s, you'd start to be buying, foreign currency. I think if you've got debt, again, I think you have to just continually watch the yield curve, watch what's happening in the longer end of that curve, obviously follow what the central banks are saying and doing, and I suppose what's the relativity between bonds and equities. And again, if you're looking to do any longer dated fixing, again, you might just have orders out there or look over that thinner Christmas period, because that would be a good time for central banks potentially to try and engineers, most probably not the right word, but to try and maybe flatten that curve a bit, because I don't think they want to see the 10-year bond rate, which is around 0.95 at the moment percent. They don't want to see that at 1 or above. So they might try at times to either talk down or act in the market to flatten that curve a bit. And I think for borrowers, watch that if you're looking to do longer duration hedging.
Fabulous. Well, Michael, thank you very much for a chat today, but more importantly, it's been awesome chatting to you all year. I know that the treasurers out there are still listening with vigour around your predictions. So thank you for your time again this year, and I look forward to chatting with you again in 2021.
Well, I certainly hope they haven't followed my equity tips, because they'd all be bankrupt, I think. So I sincerely hope no one's followed that, because the share market's been a bit of a surprise to me, which is why I don't trade it very often. But no, look, it's been a pleasure. I wish everyone a great Christmas and New Year break. I think we all need some time out, and I think most importantly, everyone to keep safe and come back bigger and brighter for 2021, which will hopefully be a more normal year than this one.
Chat soon.
Okay, thanks, Simon.
Hello and welcome to the Treasury Talent Podcast. I'm your host, Simon Lynch. Before we get underway, I just wanted to remind people that to have a look at Treasury Talent TV, which is our YouTube channel. We've got lots of really good information that's 24/7 on demand there. We're actually doing some live events and discussions. So if you want to ask a Treasury recruiter, we've got that on Mondays. We've got our usual live podcast that happens on Wednesdays. And we're just setting up a new segment, which is going to be Ask a Treasurer, to be able to listen to and ask questions from some of the leading treasurers out there. Today, I'm joined by Michael Braude. Michael is the treasurer at George Weston Foods, and he's on for his regular economic forecast for treasurers. I hope you enjoy Michael's chat today. It's going to be our last forecast before the Christmas break. So I hope you get some insight now to lead you through that December, Christmas and holiday period.